Welcome to The Explainer. Okay, we've got to talk about one of the absolute most fascinating disconnects happening in the market right now. Imagine a company that goes public in 2012 at roughly $2 billion valuation and then casually delivers a 100x return over the next 13 years, peaking at $220 billion. For a brief moment there, it was quite literally one of the largest pure-play enterprise software companies on the planet. And then, out of nowhere, the stock crashed. But here's the wild part. The fundamental data, it was breaking records. So today, we are decoding this massive disconnect, and we're going to look exactly at why the market might be fundamentally undervaluing ServiceNow.
Okay, let's dive into this. Here is our roadmap. First, the earnings crash paradox. Second, what ServiceNow actually does. Third, the terminal value fear. Fourth, testing the moat with 4 hard data signals. And finally, the bull case and upside.
Section 1. The earnings crash paradox. Record numbers, crashing stock. To really get this, we need to go back to Wednesday, April 23rd, 2026. On that single day, right after their Q1 earnings report, a truly bizarre market reaction unfolded. ServiceNow's stock dropped a staggering 18%. 18! It was the biggest single-day drop in the company's entire history. Billions of dollars in market cap were just wiped out in hours, bringing the stock down roughly 57% from its all-time peak.
And this brilliantly illustrates the paradox, because the numbers they reported that exact same day? Phenomenal. We're talking 22% subscription revenue growth. They beat guidance and actually raised their full-year projections. They were sitting on a $4 billion mountain of cash. Their renewal rate was a rock-solid 97%. And honestly, perhaps most incredibly, just 19 months into their AI strategy, they were already booking a $1.5 billion run rate in pure AI revenue. I mean, if you just heard these stellar metrics in a vacuum, you'd think the stock would be soaring, right? Instead, it plummeted.
Section 2. What ServiceNow actually does. Orchestrating the modern enterprise.
So to understand why the stock crashed, we first have to understand the exact problem this company solves. You just can't value them properly otherwise. And that problem is perfectly quantified by this one number, 897. That is the number of disconnected, siloed software applications the average large enterprise is running right now. Over the last 2 decades, every single department bought its own shiny new tools. And the problem? None of these tools talk to each other. When a complex task needs to happen, say onboarding a new employee or investigating a security breach, the work doesn't live in one app. It threads through dozens of them.
Think of enterprise data like a giant layered cake or a stack. At the bottom, you have your basic data storage, compute, and AI reasoning. But here's the reality. Those lower layers, they're commoditizing fast. Inference costs have dropped like 99% in recent years. Raw intelligence is getting cheap. But ServiceNow doesn't live down there in the basement. They sit comfortably right at the top, in action, orchestration, and the governance wrapper. They're the maestro. They sit above those 897 applications and run the workflows that connect them all, while making absolutely sure every single action complies with the Fortune 500 company's strict governance rules.
Section 3. The terminal value fear. Why the market panicked.
So, if they sit at the very top of the stack with these fantastic numbers, why on earth did the stock crash? Well, we have to look at how the market is currently categorizing software companies. We have your AI native infrastructure and domain defenders holding up decently well. Then you have the disruption zone, companies where the market is terrified AI will fundamentally break their business models, and they're down around 51%. Now, ServiceNow is technically a platform transformer, but notice their year-to-date performance, down 48%. The market is unfairly pricing ServiceNow as if it belongs in that highly vulnerable disruption zone. They're assuming AI agents are just going to come in and completely kill their software as a service model.
It all boils down to this absolutely crucial concept, terminal value. When institutional investors value a company, they don't just look at the next few years, they look at terminal value, which makes up, 60 to 70% of a growth company's entire worth. The market isn't doubting ServiceNow's next 4 quarters. Those are totally fine. The market is panicking over its next 40 quarters. They're asking if autonomous AI agents can eventually do all this coordination, is the workflow layer still going to generate premium margins 10 years from now? That fear is what triggered this massive repricing of the stock, completely ignoring their current stellar earnings.
Section 4. 4 signals testing the moat. Demand, profit, AI monetization, and displacement. Now, what's really interesting about this next section is we don't have to just guess if this panic is justified. We can systematically test the market's fear against cold, hard data. Signal 1 tests the bear case that demand is slowing down. We measure this using constant currency current remaining performance obligations, or CRPO. Basically, that's the dollar value of contracts customers have locked in for the next 12 months. For 5 consecutive quarters, through every single AI panic cycle the market has thrown at this stock, CRPO growth has been almost perfectly stable at exactly 21%. That is not a deceleration. That is rock-solid stability. The bear case on slowing demand simply doesn't hold up.
Signal 2 looks at profit. The bears rightly point out that GAAP net income grew less than 2%, largely because it was diluted by high stock-based compensation. And that's a real cost. We definitely have to be transparent about that. But look at the insider actions. The C-suite executives have actually halted their automated selling programs. The CEO, Bill McDermott, is out there personally buying stock. And the board, they just authorized a massive $5 billion share buyback. Insider buying at depressed prices is pretty much the strongest signal you can possibly get that the people running the show believe the stock is significantly mispriced.
Okay, moving to signal 3, AI monetization. Can they actually charge for AI agents? This quote beautifully captures the bull case here. For enterprises, control is not friction, it is the product. ServiceNow isn't selling raw AI. As we said, raw intelligence is a commodity now. They are selling the vital infrastructure, the identity resolution, the strict audit trails, the complex permissions that makes AI actually safe to run inside a Fortune 500 company. They take a brilliant AI agent and make sure it doesn't become a brilliant liability.
And Signal 4 completely crushes the narrative that competitors are displacing ServiceNow. 97% of their customers renew. 97. Through every single claim that native AI startups are rebuilding the category from scratch, this number hasn't budged an inch. Think about it. If displacement were actually happening at scale, this metric would be the very first thing to break. It hasn't.
Actually, scratch that. They aren't just staying, they are expanding. Customers spending over $5 million grew by 22%. Get this, the 2011 customer cohort is now spending 228% of their initial contract value. Replacing ServiceNow's deeply embedded systems takes years and tens of millions of dollars. Customers stay because ripping out and replacing the software costs way more than just keeping it. This is terminal value compounding right in front of our eyes in real time.
Section 5, the bull case and upside, calculating the asymmetric bed.
Let's bring this all together into the final valuation. If we walk through the scenarios, at roughly $90 a share right now, you're paying a mere 16 times forward free cash flow for a company growing at 20%. I mean, that's a multiple normally reserved for slow-growing, mature legacy companies. If the bear case plays out, your downside is roughly 20 to 30%. But if the base case holds, you're looking at a flat to modest return. And if the bull case materializes, you see an upside of up to 38%. Because you are paying such a low multiple of 16 times free cash flow, the downside is largely already priced in. It creates a highly favorable, completely asymmetric expected value.
And the best part, you don't have to just guess which scenario is going to win out. You can verify this entire thesis using future earnings data. Here's your timeline to watch. Check the CRPO numbers on July 21st. Look for the trend in October. Watch the full-year guidance in January 2027. This timeline empowers us to watch the hard data quarter by quarter rather than relying on blind market panic.
Before we wrap, I have to highlight this quote from Jensen Huang, the CEO of NVIDIA. He openly calls ServiceNow the operating system of our company. Think about that. When the CEO who is literally building the frontier AI hardware tells you that this platform is their operating system, it proves a massive point. As intelligence gets cheaper and more autonomous, the execution and workflow layer that applies it safely goes up in value, not down.
Which leaves us with this final, rethinking the entire narrative kind of question. If AI agents do all the work tomorrow, who governs the agents? Raw power goes viral, sure, but constrained, governed products are what actually capture durable value. The data strongly suggests that AI actually increases ServiceNow's terminal value because those agents need a secure, governed environment to even act. It's a completely different perspective, isn't it? Keep an eye on those data checkpoints, and as always, keep learning.